that time of the week again where we pick from the investment mind of one of the industry's strategic thinkers. And in the hot seat for today's strategy session, we've got Peter Brooke, Head of Macro Strategy Investments at OMIGSA. Thanks so much for joining us this afternoon, Peter. We've got the markets trading on an 11 times forward PE roughly, so looking cheap, and yet investors reluctant to pile in, some saying they see the upside as limited while the downside looks a little bit more severe. What's your overall view on the markets right now?
At the beginning of the year, we suggested that it was going to be a lower return world. And that's really because most asset price classes had repriced. And so if we look this year, actually not much has happened. We've had lots of sound and fury and up and down, but markets are broadly flat. The key thing about that is that with time, as earnings come through, the forward multiples get cheaper. And as multiples get cheaper, then your expected returns go up. So generally, value is starting to come through. And that's the good news. The bad news, of course, is the risks. And there's a whole host of risks if you look out there. Predominantly the European debt crisis, the US debt issue, Chinese growth, and potentially oil price pressure out of the Middle East tapping out growth. And I think we're balancing between those factors. And so in terms of our view, I would say that in the long run, valuation comes through. Equities have derated. They're looking a bit cheaper. We'd say they're fair value. Therefore, you should have a reasonable allocation as per your right allocation. So if you're young, you need to have quite a lot. If you're old, you'd have less.
We'll get a little bit more specific a little later on, but let's unpack that risk scenario, because you've highlighted 4 risks that prevail, and that within a global arena, but it seems more so than anything else. We've got risk 1 and 2, those pertaining to the Eurozone and the US, overshadowing the risks that prevail when we're looking at China and the Middle East. Are we underestimating the kind of risk that China and the Middle East could offer at this stage?
I think you're certainly right. Markets are tending to be like dominoes. It's, okay, we're scared about Europe. Well, Europe's resolved for now. Right, we're scared about the US. Hopefully next week we'll say US is resolved. What are we worried about next? So if I look at our base cases, none of those bad scenarios are expected to come through. But the one that is obviously most worrying for South Africa would be a China hard landing. If you look at China for the last decade, it's grown its GDP by just over 10%. And our expectation is that'll come down to average around 8% in the next decade. And that's actually an excellent number. So good growth, keeps the wheels turning, good for our commodity producers. However, when you transition from a higher level of growth to a lower level of growth, there is the risk that you undershoot. And particularly an investment which was juiced up 2 years ago in the subprime crisis, are we going to have a sharp slowdown? So in terms of risks, it is a genuine risk, probably a 20-25% probability, therefore not a base case, but if it does happen, very negative consequences for our market.
We've had traders at the desk say that it's very interesting if you look at the kind of risk scenario the developing world and then the developed world is pricing in at this stage, because it seems developed world markets are pricing in significantly higher risk than that of, let's say, emerging markets. What are you making of that distinction that's playing itself out?
Well, if you look at it, one of the ways of looking at that risk is looking at volatility. And certainly the pricing of volatility in developed markets suggests people are more scared there, putting on more protection than we have in emerging markets. And I think if you look behind that, it's really obvious as to why that's happening, because markets are saying, what are the greatest risks? So this year, when we looked at markets, they're broadly flat, but those countries worst affected by the European crisis were sharply down. So they focused on what was going to be hurt. And longer term, what we see in terms of the major risks are not a big problem for emerging markets. So if you're going to protect yourself, you're going to protect yourself in a developed markets, because that's where the risk lies. And for most people, they're still underweight emerging markets in terms of their long-term allocations. Therefore, they're less likely to protect that because it's still quite a small part of their
portfolio. Absolutely. Let's take a look at your strategy now and delve into asset allocation specifically. In terms of asset allocation, how are you spreading your portfolio at this stage of the game?
Well, as I highlighted, both local and international equities have derated, and therefore equities we would still expect to give the best real return over the next 5 years. And in fact, those returns have increased a little bit with the cheaper prices. So probably in the region of 6 to 7% real per annum for the next 5 years. That's a reasonable return, much in line with the long-term history. When we look at the other asset classes, internationally it's easier because they look terrible. And so offshore cash, offshore bonds, we expect very low levels of return. Therefore, in terms of offshore investments, we'd be very heavily biased towards equity and perhaps a little bit of property. In South Africa, on the other side, SA bonds have derated a little bit this year from the beginning of the year. In other words, bond yields have ticked up, and a yield of 8.3%, inflation, let's call it 5.5% to 6%, you're getting a real return of between 2.5% and 3%. Not great compared to the history, but probably a fair return, so fairly neutral on that. Tactically, maybe a bit cautious in terms of stage of cycle. With rising inflation, eventually rates will go up. And then the other asset class in South Africa is cash. Historically, cash has given a very, very good real return in South Africa, and that was deliberate government strategy to keep interest rates high, to kill inflation. But that's happened largely, and we definitely feel that those real returns that have been delivered on cash are going to be a lot lower. And you'll be lucky to get between 1% and 2% real. So not a good way to grow your wealth in the long run.